guys, we're going to talk tonight about indexed universal life. And of course, the reason we labeled this presentation tax-free wealth is because indexed universal life doesn't really mean anything to most. It's not something that's talked about in everyday conversations, but it's something that can impact your financial life in a big way. And tax-free wealth is probably the best way to describe what most people use indexed universal life for. So we'll get to work. Just some things that it's really great for here: college savings, tax-free, savings in retirement, and employee bonus and retention. So lots of ways that you can use this, but let me go through this presentation for you. And, at the end of the presentation, if you like what you saw, if you want to know more, and most of all, if you'd like a free, no obligation meeting, an illustration to show you what your savings could look like, just contact the person that invited you to this presentation, and our team will be happy to help you out. So we are just that, a team, right? We're a team of agents dedicated to educating families, employers, and entrepreneurs on the benefits of advanced markets to facilitate tax-free wealth while protecting what matters most. We are the Newbauer Agency, and we are under the banner of Quility, which just won an industry award, one of the most prestigious industry awards out there for 2022, called the Stevie, and Symmetry Financial Group, which is the wholly owned subsidiary that we work with. We also work with dozens of A-rated financial and insurance companies, which allow us to create the best savings and protection solutions for you and your loved ones. So we do all kinds of stuff protecting families across the country, but tonight we're going to focus on what we like to call living benefits, and show you how to build that tax-free wealth, right? So first of all, what is indexed universal life? Indexed universal life is one of the more innovative wealth building options today. First and foremost, it provides a death benefit like all life insurance policies do, right? The difference is that this one also provides a buildup of cash inside the policy. This cash is not exposed to market risk and can be accessed tax-free and is liquid.
Lala, come on.
Anybody's been watching the markets, I think we can all see that there may be some scary times ahead. Don't know how long that may or may not last. I'm not a financial advisor, but definitely people losing some money in their portfolios, which is why we called this meeting tonight, to help as many as we can. An IUL is not for everybody, right? There must be an individual in the household with insurable interest that qualifies for the policy, right? First and foremost, factors that impact this can be health, prescription history, and a background check. Real quick, the history, guys. Life insurance has gone through a lot of innovations and evolution through the years. Initially, it was just for protection with the term policies. Hey, God forbid you die within the next 20, 30 years, then you'll get a payout. If you don't, well, all that money was probably well spent, but it's gone, right? In the 50s, they came out with cash value whole life. This is what really spawned the design of what we know as indexed universal life today, was the idea of permanent policy with tax-free cash value. And then did come universal life, which was kind of a mix between whole life and some term. It allowed you to basically vary on what you might pay for premiums and stuff like that. And in the 80s came variable universal life, which had direct access to the market. So you had tax-free growth, but you were also exposed to market losses. And so in 1997, permanent life insurance protection with the opportunity to earn market-like returns, but with those guarantees in place, what was invented, and Transamerica was the first company to come out with those. I didn't know that until a couple of weeks ago, and putting this presentation together. So the benefits, guys, were protecting your family in the case of critical illness, chronic illness, death, but more importantly for these purposes, wealth and cash accumulation, right? And this is what we're really excited to show people, because as Brandon Nevis, an expert on our team, likes to remind all of us, this is the last known asset of its kind. There is no other way that I'm aware of in which you can grow wealth tax-free and access it tax-free if you utilize these correctly. And it's a very simple process. So protection is offered in 4 key areas, guys. We're protecting your income and your family. We're protecting you from market risk, protect against taxes, and protect against outliving your retirement income. Key terms for you guys to know: when I say accumulation, I mean growth. When we say distribution, you're distributing the money to yourself. That's income, right? And legacy, which is a big part of this, is overall protection and passing down to your family. So you get to enjoy those benefits now and also pass them down to your family. Now I'm going to get into what it does, right? What does Index Universal Life do? When you qualify for an IUL, you're getting permanent coverage as long as the premiums are paid. This is a life insurance policy with the death benefit. And it also includes living benefits in the case of critical illness, like stroke, heart attack, cancer, chronic illness, which is the inability to perform a number of daily tasks of living, and or terminal illness, when God forbid you're told by a medical professional that you've got a year to 2 years to live, right? All of these benefits are built into the policy so that you can access that money now. You don't have to die to receive it, which is why in our industry we call it living benefits, right? So Index Universal Life is designed to increase in value during your lifetime through a cash value component that grows tax-free, and it can be accessed tax-free. The cash value earns interest based on the performance of an underlying market index, which I'm going to get into in just a second. You don't have to be a financial professional to understand any of this. We're going to be clarifying it throughout the presentation. But what it means is even if the index goes down, the stock market, right, for instance, your accredited interest rate is never less than 0% guaranteed. So you will never be exposed to losses in the market, but you've got the opportunity to participate in the market through a unique design here. And here's how it works. An index, for instance, is the S&P 500, right? Which most of us have heard of. It's the 500 large cap common stocks actively traded in the United States. Then there's another index that we like to use, the Barclays Trailblazer, which is a diversified portfolio of assets that their team feels has the highest return potential for a given level of risk. And what happens is the cash value in these, I'm going to say IUL now, okay, Index Universal Life, we abbreviate in the industry as an IUL. So the cash value in an IUL earns money based on the performance of a selected stock index, but with a built-in floor protecting you from market downturns, and a cap, which equates to the highest interest rate the account can earn. So, for example, let's say you've got a floor of 0% and a cap of 9.5%. Well, if the index goes down 4%, you're not credited anything, right? But you don't lose anything either because of this floor. Let's say it goes up 21.8%. That'd be nice right now, wouldn't it? Well, it's got a cap of 9.5, so you are going to be capped at that earning rate of 9.5. And I'll show you the benefits of this later. Why does 9.5 make better sense in this environment than a 14% when you've got that downside protection? We'll go through that. And then this just shows you the mid-range. You're going to earn what it yields. So here's our buddy Warren Buffett, right? He knows a little bit about money from what I'm told. His number one rule is never lose money. And rule number 2, never forget rule number 1, right? So I'm going to go over what a cap can look like in terms of are you a host? No, Laura. Sorry guys. Laura came back in. Wanted to make sure she had the access that she needed. So guys, here's a nice example of how caps and floors can protect you. So let's say you have $100,000, just to use round numbers, our arbitrary figure. Let's say you have $100,000 in a regular stock account and it drops 15%. You're going to be down to $85,000 in your portfolio, correct? Now, if you had the same amount in the cash value of an IUL and the index drops 15%, you still have $100,000 minus some nominal fees that come with managing the policy and all that. We're talking hundreds of dollars in this case, right? So 85,000 versus 100 if the market goes down 15%. But here's the best part. In our example, let's say that the next year, that same index grows 15%, right? That's a nice return. Well, in your stock account, you're up to 97,750 because you're catching up, right? You got to get up there. Almost back to where you started. But in the IUL, which you didn't lose any money in, you're already up to 115,000, right? So long as you've got that index cap at 15%. Now, the companies we work with usually cap out at about 14%, but again, that's something you'll talk to your agent about. So the floor prevents you from losing money, and more importantly, guys, what's the most valuable commodity that any of us have in this life, right? It's time, right? Not money. You can always make more money, but it's very difficult to get more time. So this example demonstrates that very clearly. And here you'll see a chart just for us visual learners, right? Here it is alongside, let's say, a 19-year span from 2000 to 2019. We're looking at this index growth. If you're participated directly in the stock market index, this is what the portfolio looks like, right? You're going to enjoy those ups and suffer the downs. But with the zero floors built in, you can see what this looks like, right? At the end of the period, with those zero floors, even with a cap of 12%, this is what I should have prefaced it with, right? But even with a cap of 12%, even though some years, look at this, 29.6%, right? It's a great return, but you get those down years, and over time, having that floor and cap brings you an additional $131,255 into your portfolio because of that protection. That's powerful, right? So if you invested $250 per month in each of these investments for the last 40 years, here's what they would yield. Hide it under the bed, you're going to have $120,000. There's no return there. The mice don't crawl under and add little dollar bills every couple of days, right? High yield savings account, 2%. I don't know where you get that, but I'm sure they exist. $183,609. Your home, ups and downs, 274, 294. The S&P 500 index fund had an average rate of return of 10%, and you'd have $1.6 million at just $250 a month for the last 40 years, right? So what's your plan for the next 40 years? So here's how an IUL works, guys, real quickly, because I want to get to the meat of this. You pay a premium, you accumulate cash value, less the policy charges and expenses. There's fixed and indexed accounts. We like working with the indexed accounts for all the reasons I'm discussing here. And then you can access the money through withdrawals and loans. Now, we're going to teach you, you never want to withdraw that money, because so long as it's in the policy, it's tax-free. Well, how do I get my money then? We're going to get to that, right? That's through a loan. And then there's, of course, a policy death benefit. So unlike, say, a 401k, maybe you put your first, $100 in your 401k, and then tomorrow you get hit by a car, your family has $100, right? With a death benefit built in, put that $100 into your policy. God forbid you get hit by a car the next day, and you've got whatever that face value benefit is, 100,000, 500,000, whatever you've designed your policy for. So why does this work, guys? How is this possible? Think of it, first of all, as a Roth IRA, which most of us are familiar with, married to a life insurance policy. That's really what these are in concept, right? So we are taking advantage of an IRS rule known as Rule 7702 of the IRS tax code to overfund a life insurance contract with the ability to I shouldn't say withdraw, to access tax-free wealth. I'm going to correct that. A life insurance policy loan isn't taxable, all the while the principal amount earns interest. Now, I'm going to go over that again, guys. You're loaning money to yourself, right? We'll cover this visually in a second, but you're simply borrowing against your own principal. So if you have 100,000 in there and you borrow 30 to go pay for a college education, you still have 100,000 in there growing. That's leverage, right? So you get to enjoy the best of both worlds, provide a death benefit and provide tax-free savings and retirement income. And guys, the reason I am so animated about this, my team knows, and we all share this sentiment. This is just something that will never be taught in schools. I should never say never, right? But it's not taught in schools. The bank certainly doesn't want you to know about this. And your fund managers certainly don't want to talk about this, because there are no fees to be earned year after year after year on your portfolio with a life insurance policy, right? So we're very passionate. Our mission as a team is to share this with as many people as possible. The very best thing anybody can do, it's for the most part, never too late. But this is something that, our primary mission is to make sure every child and grandchild in the country has one of these. And we can change things generationally with this. So pardon the tangent there, but we are very passionate about helping people. So Rule 77.2, very simple, guys. It differentiates between income from a genuine insurance product and income from an investment vehicle. So long as it's categorized as an insurance policy, it's tax-free. Very simple. I'm going to sum all that up since I tangented. But that's how it works. I love this from famed CPA Tom Wheelwright. Most people think the tax law is a ball and chain meant to rob you of your hard-earned money. Wrong. The tax law is a series of incentives that can make you rich faster than you ever thought possible. We just have to know how to use it, right, guys? I need a drink. Non-alcoholic, it's just water. All right, guys, so leverage your wealth with IUL. This is what I was referring to earlier. The funds for your IUL loan don't subtract from your policy's cash value, right? Instead, the insurer is lending you money, usually at a rate much lower than a bank loan. It's usually LIBOR plus a point or two. Instead, the insurer lends you the money directly and uses your cash value as collateral. So this is important because it means the cash remains in your policy and continues to earn investment income and compound while that loan is outstanding. This is quite different from a 529 or a 401k, which removes the funds from your retirement plan and reduces your investment performance going forward. So you're getting a lot of compound growth here with the IUL. Now, again, we love talking about children and grandchildren because frankly, the younger and healthier someone is as the insured, the better this becomes, right? Time is money in this case. And if we can help the children first, as Whitney Houston sang once, children are the future, right? True story though, if we can help the children and the grandchildren first and foremost, then generationally we can start educating people more than ever on finances, which is just not taught in the schools. So an IUL for children is flexible, the growth is tax-free, and the funds can be used for education, a down payment on their first home, opening a business, and so much more. And the overall utility is extremely versatile when it comes to a child's financial future. Most parents wish to give their kids a head start wherever they can. So today we're going to look at using an IUL for college savings as an example. And then I'm just going to go into a couple more ideas for everybody. And from there, of course, we can do deep dives with you and help everybody out. But here's some stats about college planning that you might find interesting. So, and these are 2022 stats. The average cost of college in the United States is $35,331 per student per year, and that includes books, supplies, and daily living expenses. The average cost of college has more than doubled in the 21st century with an annual growth rate of 6.8%. The average in-state student attending a public four-year institution spends $25,487 for one academic year. In-state tuition is around $9,000, out-of-state's around $27,000. The average traditional private university, we're looking at a total of $53,000 per academic year, 35 of it on tuition and fees. So considering student loan interest, loss of income, the ultimate cost of a bachelor's degree, college education could exceed $400,000. It's why we have another kind of pandemic in our country right now when it comes to student loans, right? And the debates therein. We've got a big problem, and guess what? We're the ones that started it. Not us, right? But powers that be. So here's a difference between the IUL and the 529. If you're familiar with the 529 plan, this is a government-sponsored program that allows you to save money for your child's future, your child's college, and get gains in the markets tax deferred. So it's a beautiful idea. It allows people to save money for college. Us hardworking parents can put your money into a 529. It is tax deferred. It grows tax deferred, and that can multiply nicely over the years, right? So what I want to preface first and foremost before I do comparisons to 529s and 401ks is, guys, if you're a saver, no matter where you're saving, even if it's under the mattress, give yourself a pat on the back. We applaud you. And it's not easy, and it takes willpower and discipline and consistency to do that. And so no matter what you're doing better than a lot of people, right? We simply want to educate you on a way that we feel not enough people know about, and if used properly, historically and empirically outperform the government sponsored programs. So just a few line items here. Is there tax deferred growth in an IUL? Yes. In a 529? Yes. We just discussed that, right? Are the distributions non-taxable in an IUL? Yes. In a 529, I need an asterisk there. The answer is yes, but only if the proceeds are used for college education. If your child changes their mind, wants to go into the military, wants to go into a skilled trade, decide to start their own business or join the Peace Corps, then it's taxable, right? So can it be used or transferred to benefit multiple children? Yes, in both counts, okay? Is there a no penalty or restriction for non-educational usage? That's what I was mentioning before. IUL, you can use this money and without being crass, go to Vegas and put it all on black, right? If you really wanted to. With a 529, these must be used for educational expenses if they are to remain tax-free. Is there protection from market downturns or loss? In an IUL, yes, there are. Caps and floors, right? Caps and floors, caps and floors. In a 529, unfortunately, there is not. You have direct investment in the market. When it goes up, you make money. When it goes down, you lose money. If we have another 2008 and it's time to go to college, you've got what you've got, right? So do you have access to funds due to chronic or critical illness? God forbid somebody were to suffer a heart attack, stroke, cancer, things like that. IUL, absolutely. Critical and chronic illness is built in. 529, they are not insurance products or programs, so no, that's not built in. Is it counted as an asset when applying for federal financial aid? An IUL is not counted as an asset. I'm sorry about the double negatives, right? That I might have to relook at this chart, but the fact is an IUL is not counted as an asset when you apply for financial aid. So you have $1 million in there and still apply for financial aid if the situation deemed it, right? A 529, it is counted. So here's the exciting part. So you could see those beautiful drawings behind me. I didn't do those by myself. Those are my kids' drawings, and I save every one I can. And if they let me, I'd have the entire wall plastered with them. But we love our kids, right? The kids are the future, and every generation we get a little better, I feel, at making sure our kids have the best start they can, because we're starting to realize more and more as a people and as a society that legacy really matters more than some people give consideration to, right? So let's look at this example. Assuming the market continues to grow at its the last 30 years, average rate of 8%, and you put $100 a month into an IUL through the age of 18, from birth to the age of 18, $100 a month, and then stop. They will have tax-free access to $10,000 a year for each of the 4 years of college, a $50,000 tax-free distribution at age 35, house down payment, a tax-free distribution of $250,000 at age 55. Lots of uses for that. I wish I would have thought ahead, right? Tax-free annual distributions for life of over $200,000 a year starting at age 67. And on top of this, the death benefit will have gone up from $115,000 at issue at birth to over $1.6 million at age 66 with no additional out-of-pocket costs. How incredible is that? That is the power of guaranteed returns and compounding interest and disciplined systematic savings, right? That's why we look at these as savings vehicles. So some stats, guys. 33% of Americans have no retirement savings. Look how sad they are. Less than 10,000, 23% of Americans. 10% have 10 to 50, 49,000. 8% have anywhere between 50 and 199,000. 5% have between 2 and 3, and 13% incidentally have 300,000 or more. So we want to help people, guys. Our team considers there are 4 pillars of retirement that we like to consider when expounding the benefits of this to our clients, right? Our friends, our families, our clients. Money. We need enough money, right? It's just a thing, right? We need enough money to pay for housing, transportation, food, healthcare, and leisure, right? We want to enjoy this life that God gave us down here as long as we can, and the best way we can. Purpose. We need to feel that we are useful, productive, moving forward, pursuing a goal, and are making the world a tiny bit better and leaving it better than we found it, right? That's legacy. That's what legacy is. Making that difference beyond the grave, if you will. People. We're human beings. We're sentient beings. We need love. We need compassion, love and social interaction from our life partner, children, family, friends, or animal companions, right? And our health, right? A lot of people say health is wealth. We need to feel physically healthy or be at peace with our level of health and the means to afford proper health care and wellness. Those are our 4 pillars of retirement. Money can't buy love, but it can certainly facilitate a better quality of life with those we care about and cultivate a lasting legacy for those we leave behind when we pass. So real quick, guys, not just trying to scare everybody, but this is history. It's facts, right? It's not how much money you make, but how much money you keep, how hard it works for you, and how many generations you keep it for. That's a quote by the great Robert Kiyosaki, wrote Rich Dad, Poor Dad, which changed my life, and I hope my children's life in terms of how you view finances and employment and all kinds of things. So there are several choices we have to save money throughout our life and prepare financially for opportunities, emergencies, and retirement. Today, we're going to look at what has historically been the most popular choice and why more and more families are choosing IULs as a strategy for savings and retirement. Investing directly in the market has its advantages, particularly when things are going well. But what about these years, guys, right? 2020 was no fun. And now I purposely didn't put this slide in here because I don't like, scaring people. We all know what's going on. But I recently saw an infographic comparing 2008 market to the 22 market, and they are identical in their patterns. And the only thing that remains to be seen is in 2008, it went like this. And in 2022, we're just here. We haven't seen the end of this movie yet, right? But we know what happened in the prequel, if you will, the first one. So again, I didn't include that, but I do want to tell you about it in case you're not noticing. We may be in for a storm. So again, why we decided as a team we're going to do these, every week and educate as many people as we can. So with the recent volatility in the stock market, clients are looking at alternatives to grow money without risk. The retirement vehicle of choice for many has traditionally been the 401k, right? And I include the 403b when I talk about that. Just saving some time by not saying it every time. But the 401k obviously carries market risk, right? And accessing your money without penalties until you are age 59 and a half, with forced distribution at 72 and a half, right? So a 401k also postpones taxes to the future, which can be perceived as a positive or a negative. You just have to ask yourself, do I believe taxes are going to go up or down in the future, right? If you think they're going to go down, then deferred taxation is a wonderful thing. If they're going to go up, maybe not. So what about your safe money? I like to call it your safe money. This is the money you can't afford to lose, right? Here's why we love the IUL for your safe money. So several advantages to a 401k, like I said, deferred taxation. Sometimes you have an employer match, right? And it's very convenient to invest directly from your paycheck. Those are beautiful things. Again, if you're contributing to one, you're saving. If your employer's contributing, it's free money. Great job. But when it comes to market protection and tax-free distribution, right? When you get the money, supplementing your retirement strategy has its key advantages with an IUL. Number one, they both grow with compound interest, right? So long as the money's in there, it's going to compound. An IUL has those floors in there. So is there downside protection against market loss in an IUL? Yes. In a 401k? No. Is there a tax-free death benefit in an IUL? Yes. In a 401k? No. Is there tax-free distribution? Yes, right? If we access it through a loan, yes, IUL. As 401k is tax deferred. You will be taxed when the money comes out. No matter where the market's at, if you're 72 and a half, you have to take it out, no matter where, right? Can you access the funds without penalty before age 59 and a half? An IUL? Of course. A 401k? You cannot, as people with 401ks hopefully know. Are there guaranteed minimum returns? So if the market just takes a dive, do you get a guaranteed return in an IUL? In many of them, yes. The ones we work with do. In a 401k, no, right? You're participating directly in the market. Living benefits, we covered it. Chronic, critical, terminal illness, done. 401k is not an insurance policy, so of course none of those are in there. And do you have leveraged access to cash value? Yes, in an IUL. No, in a 401k. What do I mean by leveraged access to cash value? I mean, you're borrowing against it, so the principal stays in there and grows, right? That part's amazing. Guys, real quick, did you know, right? I'm going to go over a couple people that I'm sure many have heard of. Probably everybody, a couple of these. But people, though the IUL was launched in 1997, again, the only difference between not the only difference, the high level difference between whole life policy that has been used for well over 100 years and the IUL, which came out in 1997, is that the IUL was designed for advanced access to market gains through that index. How do we protect people though? With caps and floors, right? That's how we do it. So families and entrepreneurs have used permanent life insurance to build wealth for over 100 years. In the 60s, Ray Kroc borrowed against his policy to pay key employees and fund marketing campaigns to build the McDonald's brand, which grew to more than 700 restaurants within 10 years. Today, it serves more than 50 million people, good or bad. I'm not going to comment on what they serve, but what a successful business enterprise, right? Walt Disney, nobody would fund this guy. You're going to build a roller coasters on the swamp? No, get out, right? See him on Shark Tank? Probably a no all the way around. But he borrowed from his life insurance policy in 1953 to help fund Disneyland, which was his first theme park when no banker would lend him the money. And in 2002, Doris Christopher, who founded Pampered Chef, she used her money to fund her startup, Pampered Chef, which was 7 years later acquired by Warren Buffett for $900 million. And incidentally, Senator John McCain secured his initial campaign financing for his presidential bid by using his life insurance policy as collateral. Now, I don't get political for better or for worse, guys, but the reason I mention all of these is to show you the versatility, right? And the way that this has been used through the years. I'm going to skip over this only because your agent can talk to you about it, and it does, we could go down a rabbit hole. But real quickly, guys, if you're an entrepreneur, a business owner, or you're starting a business with somebody else, this is a no-brainer, probably one of the best things that you could get to fund a buy-sell agreement, to obtain key person coverage, or provide executive bonuses for employee retainment, right? So next steps, first of all, I hope you guys enjoyed this. I would love your comments via email, and so would your agent. So whoever invited you, please send them your comments, the good, the bad, and the ugly, because our job, our mission is to educate and hopefully do so in a way that doesn't have you falling asleep halfway through, because this is important stuff for your financial future and your family if you take advantage of it. And we would love your comments. But the real next steps, guys, is let's see what this looks like for you. Yes, we're licensed brokers, but we never consider ourselves salespeople. So please look at this next step as further education. We want to show you what it looks like when you tell us how much you're willing to save every month, right? This is a savings program, is the way that we're helping people with it. And it happens to have those life insurance benefits. So reach out to whoever invited you to this. We'll also send emails out just to make sure nobody lost anybody's contact information. And we'll draw up an illustration. We'll draw up 5 illustrations. If somebody wants to know what it looks like for their kids, and and also my wife, and well, what about me? But I want 3 different versions. Great, guys. That's what we do all day, every day for people, and we love doing it. So reach out, reach up. We'll be happy to help you out. Oh gosh, thanks, guys. I got a couple compliments in the chats. I wanted to see if those were relevant. Thank you, guys. So set up a time and we'll help you out. I love this. Always plan ahead. It wasn't raining when Noah built the ark, right? So if you don't need this now, great. that's the best time to get it, right? Worst time to get something is when you absolutely need it right then and there. But if you're in that position, we're here to help, guys. We've many of us, myself included, have been there due to poor planning, maybe some bad decisions and things like that. And I just have to credit the IMO that we're with, Symmetry Financial Group. It is one of the best business opportunities that is out there today, in my opinion. I found this company 6 years ago, and it's changed my family's life. So if you like what we're doing here and you'd like to be a part of our mission and help other people with this, we'll get you trained, we'll get you licensed, we'll plug you into one of the best multi-million-dollar infrastructures, training platforms and whatnot that you could imagine. And welcome to the team. But we're not here to recruit agents unless someone's looking for work. We're here to help you with your portfolio and your planning, and we'd love for you to reach out. So I'm going to stop the share there. I cannot thank you guys enough for coming to this event. And as I understand it, we may have to look at our RSVP and maybe make the link a little bigger. We've got a really great crowd here. For what it's worth, we had people knocking on the door and messaging. We've probably got another 30, 40 people that wanted in tonight that will be here on next week's presentation. So we will be doing these frequently and consistently. Please spread the word. We're here to help you and yours, and we appreciate you sharing the event if you see it on Facebook, Instagram, or just hear it direct from one of our agents. So thank you very much, guys. Reach out to your agent with any questions.
Good job, Mark.
Thank
Outstanding.
you.
Outstanding.
How do we do on time? Oh, we did really good.
Awesome job, Mark.
I'm proud. You would be proud. Thank you, guys.
Yeah. Awesome.
Did
buddy.
perfect there.
Amazing. I kept it to 35 minutes.
Very smooth, Mark. Very smooth.
Thank you, Bobby.
Yeah, that was an amazing job, Mark. Amazing job.
Thank you.